Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thank you for joining me. As you can see, Josh is not with us this week. He's off, but he'll be back in a couple of weeks. So today I thought I'd obviously talk about the situation in Ukraine and how that is impacting markets. And really the only thing we can do is look at history and look at conflicts around the world throughout history and see how that has impacted markets. First, I'll say that historically, these kind of conflicts and the market volatility that goes along with them have been good times to be buying risk assets like stocks. It's one of those situations where you have to sort of hold your nose and buy because there's going to continue to be volatility around the news. There's tons and tons of headline risk that comes out every single day, and markets react differently to all the different headlines that are coming out. But so what I did is I looked at the 20 serious global conflicts we've had since World War II, including World War II, and there's been 20 of them since World War II. The market, to find a bottom, usually it takes about 22 days, and on average, if you look at all 20 different global conflicts, the drawdown of the stock market's been about 5%. And on average, it's taken 47 days for the market to recover the previous high. So, really they weren't that bad. In fact, if you go back and you look at World War II, so from the start of World War II in 1939 till it ended in 1945, the stock market was actually up 50% during that period, good for a 7% annualized return over that period. So World War II, I don't think this is going to be World War III. Hopefully it's not, because that will be the war to end all wars. But World War II, which was a pretty big conflict, markets actually did really well during that period. So, it's sort of one of those markets sell off with the headlines, but it's a good time to be buying equities because they're cheaper. Markets are down about 11%. From their all-time highs, so we're officially in correction territory. The NASDAQ hit a bear market last week when it was down by 20%. So a lot of the steam has come out of the market. And remember, when stocks are going down, that means risk is coming out. The other thing that the markets are looking towards is the Federal Reserve starting to raise interest rates in about a 2-week time. The markets were pricing in that the Fed was going to raise 0.5% or 50 basis points on the Fed funds rate in 2 weeks. Markets are now looking to like that's going to be more like 25 basis points or a quarter point because of the conflict in Ukraine. Only time will tell. One thing we know is markets are anticipating the Federal Reserve to raise interest rates significantly this year, and that's why rates in the bond market and the mortgage market have already moved higher. And so markets will have to reprice around that. I think one of the reasons markets didn't sell off more when Russia invaded Ukraine was that markets were already down about 10%. And so some of the steam had come out of markets. So we look at this as an opportunity. We've been putting cash to work as markets have been selling off. You get lots of intraday volatility, and we expect that to continue. This is certainly not over. And so the volatility, we need to get used to it. But when we look at the U.S. economy, when we look at earnings, the fundamentals are still really pretty good. And ultimately, that's what drives stock prices, is earnings growing over time. And we continue to believe that earnings will continue to grow over time, thereby making the companies worth more in the market. And this we view as an absolute opportunity to buy stocks cheaper than they were 2 months ago. So, as always, if you have questions about your circumstances or your situation or your account, you can call the office. Our number here is 800-743-0988, or you can email me at tyler@northwestquadrantwealth.com. We will see you back here in 2 weeks.